Welcome to TQ Talks, where taxes meet planning. Here's your host, Craig White.
Welcome back to another episode of TQ Talks. I'm your host, Craig White. Pretty sure you know that by now. If this is your first time joining us, welcome. If you're a business owner, especially an S corporation owner, this episode matters more than almost anything else we've talked about so far. Reasonable compensation. That's what we're discussing, and that is a curse word for some and a phrase no one has ever heard of for other owners. Reasonable compensation is one of the most misunderstood tax rules I've seen, and it's one of the fastest ways for a good tax strategy to turn into a problem. Reasonable compensation is very frustrating. Let me make sure I put that out there, and we're going to go over what it's supposed to be or what it is, and we'll break it down for you, but it is annoying, to be honest, right? Let's start with why reasonable compensation exists in the first place, because that's probably important. The IRS created the rule to prevent business owners, much like myself, from avoiding payroll taxes, either by paying themselves too little or no salary at all. And taking everything as distributions. And that's a no-no, right? You make $1 million for the year, zero salary, everything is a distribution, and that's wonderful because, all of a sudden you're avoiding a bunch of payroll taxes, right? Self-employment tax, etc. That doesn't exist, which is what they're trying to prevent. So reasonable compensation is about fairness, to be honest with you. It's just being fair, not about a punishment that the IRS is coming up with. And reasonable compensation, it's simple. It really means this. If you're a business owner, right, and you're actively working in it, you have to pay yourself here goes the big air quotes, reasonable salary for the work that you actually perform. That's what they're trying to ask you to do. So this applies primarily to S corps. It does not apply the same way to sole proprietors, single member LLCs, partnerships. We're talking about S corps at least in this. And we can talk about compensation because I know that is a question, and I'm sure I'm going to do a podcast. We've done it before, but I'll do another one on how compensation works for, everybody, all the categories. But this is primarily, again, for S corps. This is not optional for S corps. It's not a gray area for S corps. It's a requirement. And that's something people miss all the time because God knows we get people, thank you for referrals, we love you so much. And we have business owners come in, and that's one of the things we have to go by. We're like, hey, there's no compensation. You're not, and then we break it down to them. So when the IRS looks at reasonable compensation, they're not guessing. That's the whole thing we're getting where we want people to understand. They're considering things like your role in the business, your experience in your credentials, the time you spend working, the industry standards. They're factoring all these things, what the business can afford. That's another thing because people are like, well, I'm a 30-year lawyer, right? I've been a lawyer for 900 years, but I only made $2,000 this year. How do I pay myself $400,000? What the business can afford is a factor, right? You can't pay yourself what you don't have. What you'd have to pay yourself or pay someone else to do your job is another thing that the IRS looks at, right? So if you're paying yourself too low or it might be too high of a compensation, depending on the role you have, that's another factor. So it's facts and circumstances test. That's what this is. It's not a formula, right? It's not this precise, perfect thing that works all the time. So we see the mistakes that are often put in is that you're paying people or yourself really, you're paying yourself too little or nothing at all. That's the nothing at all is really to me, the biggest issue because it is an auditable situation for S corps. That is something that is an audit flag for S corps. S corps usually are the lower on the audit poll when it comes to business structures, and we're talking about, sole proprietors or single member LLCs or things of that nature, but corps are lower. But the other problem or the mistakes that we see are if you copy someone else's salary, right? Well, Craig and them paid themselves X, so I'm going to do that. Remember, there's a bunch of other factors that are affecting why Craig is paying himself X, right? Internet advice, because God knows that. Oh, I searched and Google told me. I mean, yeah, you can listen. I'm not even going to not Google or AI because it is extremely helpful right now. But you have to fact check. You got to figure out where's this information coming from and why are they telling you that. The IRS doesn't care about what your friend does. That's something you got to understand. They care about what you do. And that's something you need to hold on to. When we talk about reasonable compensation, I'll tell you at TQ Financial Services, one of the things we tell people is that we base your salary, because there's reasons behind it, and I don't want to go there, but we're going to tell you you're 20 to 30% of your net. That's what we're looking at, 20 to 30% of your net, because that's something we found that works, and it gives you the, I don't want to say right amount, right? But it is the right amount of taxes or payroll, right amount of salary, depending on your position. Now, that shifts, which I'm probably going to talk about later, and it's supposed to shift, and that's a problematic situation as well. But I just want you to have an idea of what you're doing. And again, that can change for several reasons. For example, I'm paying myself X now, but I want to qualify to buy Y later. Then I might want to increase my salary beyond that 20 or 30% of my net that I just spoke about, right? I want to purchase something, or I have investment strategies that I want to utilize, and the higher salary is going to allow me to do more. Again, I'm not going to go down that rabbit hole because that's probably problematic. That might be another episode. But just keep in mind, again, it's not a one size fits all. It is based on what's going on in your business. And again, reasonable compensation is going to deserve more attention because payroll reporting is tighter now, right? If you guys have ever tried to get an apartment, I don't know if some of you are looking, but they have the ability now to scan your W-2s, to scan your paycheck stubs, to scan everything to make sure it's legitimate. And data matching is stronger, which is part of what I was just talking about. And again, entity structure and planning increases scrutiny. It does, and it really depends on what's going on and how your structure is. Again, S corps are lower in the audit poll, but that doesn't mean they don't get looked at. So planning, or, again, we're talking about the structure and what's going on with putting yourself on a reasonable compensation. The salary you pay yourself affects your payroll taxes, your distribution, your retirement contributions, and those three things we actually use when we're doing tax planning strategies. Because too low is an audit risk, too high is you're paying yourself too much in payroll taxes. So that defeats the whole purpose of the entity structure, or one of them, right? So it's a really important strategy to be able to plan around. And so the good planning, you find a balance, not a minimum, but a balance, right? So I want to be very clear that reasonable compensation is not a perfect fixed percentage. It's not a one-time decision, which is something we see all the time. Hey, I was making $300 million, so I paid myself X. Now I'm making $30,000. I'm still keeping it there. No. You adjust it based on how the income has gone up or down. It's not a set it and forget it strategy. It is also not something your payroll company decides or your software automatically calculates. This is where the interaction between you and the human come into play, meaning the person, the representative, I, Craig, being in that position, would be talking to you about what that salary decision can do for you, positively, negatively, and in between. Reasonable compensation is a planning decision. Keep that, please, in your mind. It's a planning decision. If you're an S corp owner and no one has ever explained this to you, that is a problem, which again, we've seen hundreds of times, literally. What reasonable? What? Who? What? I have to do what? You have to understand how this works. We tell people all the time, we don't expect you to know how to do your taxes, but we do expect you to have a better understanding of your business structure and what it entails. If you haven't revisited your salary in years, that's also a problem. You need to be checking on it and speaking to whoever's preparing your taxes or helping you to tax plan. If you're not tax planning, of course, that's what we're here for. You need to be paying attention to that and adjusting it accordingly, or at least have the conversation to figure out how it affects you. The cost of getting this wrong is almost always higher than the cost of getting it right. Right? So it's not something for you to panic about and say, oh my God, this is crazy, I don't want to do it. It is something you definitely need to prioritize. It's something that once you understand and, again, speak to whoever, hopefully us, TQ, about, it's not a big deal. It's a brief conversation. It's something you understand. It's something you adjust. And again, depending on the tax planning strategy we're enforcing, it's something we will adjust, right? But again, we know this is helpful. The key takeaway, like I said, we're doing this every single episode. Reasonable compensation isn't about paying yourself as little as possible, because I know that's one of the things people want to do. I don't want to pay. It's about paying yourself appropriately. And appropriately is bold, capitalize, italicize, underline, because it's going to depend on the planning strategy and why we're paying ourselves that number. All right. So please talk to your tax professional. If you haven't revisited or talked about it at all, again, our information, 800-413-1456. I probably haven't said it on any of them because you know us. You know how to reach out to us. But feel free to give us a call. We'd be happy to help you out, to set up a strategy session to figure out how we can put you in a better position. Next episode, I'll probably talk about why business owners are extending their returns, because I know that's one of the weirdest things people hear when you first jump into business. Every March, right? Especially if you're a corporation, they're like, we'll do an extension. It's like, what are they extending? And what does it actually mean? We'll dive into that. I'll try to explain it more for you, help you to understand the purpose and the pros and cons, because don't think it's all sweet. That's all for TQ Talks for today. Thanks again for listening. Have a blessed and wonderful day.
Thank you for listening to TQ Talks. If you enjoyed the show, please rate and recommend on iTunes, SoundCloud, or wherever you get your podcasts. You can also get more information at tqfinancials.com.